Ahead and get started after our soup and salad lunch. I hope everybody enjoyed that. Please remember that we have to sign in to each individual session as that session begins on our telephones, cell phones, and at the completion of each presentation we have a survey that will pop up. We need to complete those surveys in order to get our CPE certificate late Friday afternoon. I want to remind everybody that at the conclusion or at the end of the 3 o'clock session this afternoon, we'll have what we call CIPS and CPE. The CIPS and CPE today is going to be beer and wine. Kind of provides an entertaining conclusion to a day of CPE. It's my honor to introduce you all for our first session after lunch today, Mr. Matt Gilbert. He's going to discuss appropriate advice for mergers and acquisitions. Matt Gilbert is a co-founding partner of Gilbert Pardue Transaction Advisors. He has 35 years of experience as founder, partner, president, CEO, or shareholder of successful middle and lower middle market businesses. These roles equip Matt with a wealth of experience in transactions where his ownership, likelihood, and personal funds were at stake. He brings to his clients the perspective of having been and walked in their shoes when evaluating the sale of a business, as well as assessing acquisitions, taking on debt, restructuring personal and processes, and other strategic business decisions. So I would ask that y'all join me in extending Matt a warm Texas Society of CPA welcome. Thank you, Matt.
You can turn it on. Let's see, is this thing on? Can you guys hear me? There it is. We are having some technical difficulties with the PowerPoint, so I'm going to go ahead and start, and I'm just going to wing it, and it may come up here in a minute, but we can get through this without it if we need to. As was mentioned, my name is Matt Gilbert. I'm in the Houston area. I have been a independent business owner my entire life for the past about 35 years or so. I've been a part of 5 companies as a founding shareholder. The first 4 were acquired. The first one and the last one were acquired by public companies. The 2 in the middle were acquired by private equity. So that's 4 sales I've been involved in where I was a major shareholder. And then go to the last slide real quick, just before you put it up. And okay, that's it. To grow those businesses, we made over a dozen acquisitions successfully. I was involved in more than a dozen others where we were the unsuccessful bidder. And so my career as a business owner, kind of an entrepreneur, was such that I was involved in many mergers and acquisitions as a founder, as a buyer, as a seller, as a financier. And then now in my second career, we're in our 8th year. Thank you. How'd it work? Just hit the green button? Okay, cool. Thanks to the technical staff here. They're doing a good job. And so I've sat at every seat at the table except the attorney's seat and the accountant's seat for transactions. And so I've talked to this group a couple of times, and Christy asked me to come today and just kind of talk about best practices for when you guys, I assume you're practicing CPAs, and I assume that you have business owner clients. A pretty interesting story that I hear frequently, but I heard this a couple of weeks ago. A business owner was bragging about how well they keep their books and how well they have their information organized and wanting to do business with us. And so I was talking to that business owner, and this happens frequently. She told me that her relationship with her CPA was fantastic, and the CPA knew more than she did, and I should talk to that person. So a couple days later, I'm on the phone with the CPA, who says, Which customer are you talking about? Yeah, we compile their taxes once a year. We've done so for more than a decade, but we really don't know them. We really don't know their business that well. And so what happens frequently in my business is the business owner feels like they have a fantastic, very close relationship with you guys, and they feel like you guys are always thinking about their company and their financials, and maybe you do their tax returns, maybe you close their P&L monthly or something like that. But you have dozens or hundreds of clients that you do that for, and each one of those clients really feel like they have a trusted kind of advisory relationship with their accounting partner. And when we turn around and talk to the accounting partner, it's not really the case on the other side of the fence. And so part of what we've experienced over and over and over is when a business owner starts thinking about succession or thinking about selling their company, or the kids don't want to take over and they don't know where to turn, there's a couple of people in their life that they think have some expertise and that they can speak intelligently to them about that. And most of the time they will turn to you before they turn to their spouse, or they will turn to you before they turn to their business partners, before they tell their banker, or they tell their attorney, or before they call me. They're going to turn to you and say, hey, I'm thinking about, a couple of years away from selling the business. What should I do to get ready? Or oftentimes somebody's ill, my spouse is sick, I want to sell the business so I can spend more time with that individual, something like that. And we find that a business owner really feels like they have a confiding, trusting relationship with their CPA or their accountant. And you guys probably don't know that. Some of your business owner clients who you barely know at all would tell me that you're their closest confidant. And so part of this conversation is just to kind of let you in on what the thinking is on the other side of the fence, and maybe help you prepare yourself to be in a situation where a business owner asks you for advice, or tells you they're thinking about selling the business. What should they do next, or how should they prepare, or those kind of things. So that's what we're going to talk about today. Our company, Gilbert Pardue, we are transaction advisors. On the buy side, we advise private equity and small public companies, people like that, who are looking for family-owned businesses to purchase. And then on the sell side, which is the majority of our practice, we're working with probably your clients, family-owned businesses, plumbers, electricians, everyday business people in the community, who don't have the next generation prepared, or they don't have a succession plan. About 85% of businesses nowadays do not make it to the second generation. They are either sold or closed before the founding owner or partner is out of the picture. So that's, and also with the wave of baby boomers that are trying to retire and aging now, there statistically are about 10,000 business owners a day who are thinking about retiring, and that wave, we're kind of in the middle of it. It's gonna happen for a number of years to come. So that's why this is a kind of a relevant topic. And the other side of the coin is when you talk about the lower middle market, and that's businesses up to about 10 million in revenue. When they go to sell, statistically, this is a national statistic, about 82% of them never find a buyer, never transact. So it's an 18% success rate on the lowest end of the market, which is, really just an abysmal number. If you're a business owner wanting to exit, thinking you're gonna, maximize this and go into the next chapter of your life, nobody tells you you have an 18% success rate. And that success rate is impacted by several things significantly, and some of those you guys may be able to speak into your client's life about and really kind of change the trajectory and the outcome of that process. So we'll talk about all of those things. The first thing I want you to know, maybe a little bit more about our practice, just where I'm coming from. Most of our clients are probably between 15 and 100 million in revenue. they're local, family-owned businesses. You see their trucks on the street every day. You call them when you have a problem. You know, first and second generation, most of the time, are working in the business. Other family members are in the business. You go to church with them. Your kids play t-ball with them. They're friends of yours. They're the fabric of the community. That's who our clients are. And so as I go through this discussion today, that's kind of the frame of reference that I'm going to be speaking from. Is, you know, these are the everyday businesses in every town, and we run the gamut from manufacturing to professional services to construction to consulting and whatever. And I may tell some stories along the way about a few of those, but that's kind of the frame of reference of where I'm coming from. Most of these folks are really good at figuring out how to survive and run a business for a couple of decades, but they've totally stuck their head in the sand when it comes to how to get out of the company and move to the next chapter in their life. So statistics are, if any of you guys are certified financial planners or anything like that, or exit advisors, statistics are like 70-something% of business owners have not planned that chapter of their life, right? And so one of the things that we find is they have a lot of questions. They ask their brother-in-law, they ask their golfing buddy, they watch a YouTube thing, they go to a conference, and their head's filled with misinformation, right? And misinformation that they think, you know, is accurate, or they're searching to validate that it's accurate. And so pretty much what we're going to talk about today is just kind of a set of processes as best practices that will lead to the result of successfully selling a business. And if you misalign with any of these processes or derail, then the odds are really high you're going to be in that 82% failure rate category, right? And so this is just you guys being somebody that the business owner trusts to bounce and have conversations off of, and maybe they'll ask you for introduction to a business broker or a transaction advisor like myself. Maybe they'll confide in you about you know, a certain key employee that most of the sales are going through, you know, doesn't have an employment agreement, and they're afraid they're going to walk, and all these things affect the value of a business, right? And as the accounting professional, they think you know what the value of their business is. They think that you can be a part of the conversation to help them maximize that value. So the first thing we're going to talk about is just aligning yourself, your client, with proven processes. There's a lot of processes out there that rely on hope and wish for the result. And they're prevalent in my space, which is representing business owners to go find a buyer and do due diligence and get a transaction closed. Hoping and wishing is great for kids, but you know, these are big boy games, and there needs to be a proven process with the end result in mind. You step your way back and design a route to get that business owner to the promised land. And so aligning with proven processes is how you get results. The second thing is, it's astounding to me, but I'm going to estimate 95% of the business owners I talk to. Last year, by the way, I talked to 137 business owners about selling their company or getting prepared to sell their business. So if I talk to 130 a year, after about 10 years, I've talked to well over 1,000 business owners about this. I would estimate that 90, maybe even 95% of them have not gotten a fair market valuation. So their opinion of value of their business is something they dreamt up, some formula they made up, some rationale. It often includes their blood, sweat, and tears and emotions, which buyers don't care about, buyers' lenders don't care about. And so getting a fair market valuation is a huge deal. We'll talk about that a little bit more in a minute. But that's definitely a best practice that very rarely happens in $80, $100 million revenue businesses, all the way down to $50,000 revenue businesses. For whatever reason, they don't take that step, and it's critical. So we'll talk a little bit about that. Then look at that, we're going to do it right now. So how do you validate the value of a business, right? And who's capable of doing that? Most of my business owners will tell me that their bookkeeper or their controller can get with their CPA I'm assuming that's you guys, and that those two individuals are gonna come up with a defendable fair market value of the business. And when I talk to you guys, you're like, hey, that ain't what we do. We're not in that lane. If they're expecting that from us, you know, it's off base. But what I find is these people are your friends. They've been your client for a long time. You really want to help them. You care about them. And so you give advice. Whether you know it or not, you know, you're pointing them in a direction. So I just want to help you guys understand the best direction to send them down, right? There are a bunch of valuations in the marketplace. You can get a valuation for IRS defense. You can get a valuation for divorce. You can get a valuation for shareholder agreements that have to be done once a year. All of those are historical, looking in the rearview mirror. They're not good for M&A, and there's several others. And so what I find a lot of times is a well-meaning CPA will say, hey, I know this person, they do valuations, call them. Business owner calls them up, they get talked into doing a valuation that's fantastic for wealth planning, but it's worthless for M&A. They spend 30, 40, 50 grand on that. They're all proud of it. They share it with us. I get to be the one to break it to them that, you know, it's not really information that we need. It's done completely differently. So a good independent third-party valuation for M&A purposes is going to be one that's looking through the windshield, not the rearview mirror, right? Historical facts and trends and information is important. Tax returns are, you know, are important. Contracts and agreements and all those things factor in, including contracts and agreements with your employees and vendors and material suppliers and landlord and everybody else. But what's most important is what's out ahead of the business. What are they set up to accomplish? What are they in line to step into business-wise? Are they trending in the right direction? Is the future cash flow, which is what the buyer's going to buy, they're buying the future cash flow of the business, is that predictable? Is it something that we can determine and look at and control a little bit and definitely predict? And so a defendable value of the business and an M&A valuation is completely different than what most people have been exposed to with all those other types of valuations. And the funny part about this is it's probably the cheapest one out there. I recently was working with a business owner. They wanted $82,000, I think, to do a valuation, and he was kind of freaking out. And I said, well, will you send the proposal to me? And I was like, hey, this is not the kind of valuation we need. We got to looking at their company, did a little bit of research, and we charged them $9,000 to do an M&A valuation. So huge difference, and you know, probably somewhere between $5,000 and $20,000 for this type of valuation, and it's the best money spent at the front end of the process because it aligns the business owner mentally with what the market, the financing community, and lenders are going to be able to bring to the table to support a buyer to make the transaction happen. So if your business owner at the beginning of this process has a misperception of valuation, then right there you're starting off, you know, in a bad spot. And so getting that person mentally in line with what the market and the lending community and the financing community will pay is huge. How do we do that? We do that with comps, right? What similar business has sold recently? What did it sell for? It's everybody nowadays is a cash flow buyer, so we're talking about multiples of EBITDA. If it's a really small company, maybe multiple of discretionary earnings. But we want to put, you know, most of the financials in those terms. So when we do a third-party valuation, it takes us about a month working with the business's controller, bookkeeper, whoever it is. We'll go back 5 years. We'll forecast the remainder of this year. We'll forecast next year. And then we'll tweak it for other factors like inventory and management agreements and things like that. And then we'll go out and we'll test that against what comp sales have been and how we know the lending community is acting and things like that. Put it all in a nice little report, hand it over to the business owner. Hopefully they're going to discuss that with you. Hopefully they're going to discuss it with their attorney, their spouse, their partners, and everybody's going to get on the same page that this is a valuation that we can defend, right? Because if you go into this M&A expectation with an inflated valuation that you can't defend, you're just setting yourself up for failure. So that's kind of how we do this. Now, not all, we just talked about this, not all valuations support M&A. This is a different slideshow than I thought I was going to have, so I may be out of order here a few times. But deal structure is a big deal when you talk about valuation, right? So we may tell you that your client's company is worth $20 million. Well, that's probably almost guaranteed not $20 million at closing in cash, right? It's probably 70% at closing in cash. There's probably a 10% holdback. There's probably an earn-out or a seller note. There may be some rolled equity. There's a lot of structure in a deal. And so the other thing that happens to you guys probably, at least from my vantage point, is they turn to you for wealth planning advice. You know, they turn to you for, you know, hey, if I get $20 million, how are we going to do this? Well, first thing I've got to say is you're not getting $20 million right out of the gate. You have the opportunity to get $20 million for your business if you meet all the earnouts, if the holdback gets brought back to you with no issues, you know, things like that. So deal structure carries all kinds of forms, and doing a good kind of independent third-party business valuation from an M&A standpoint should culminate in you understanding the most likely deal structure that will come as an offer. Multiple on EBITDA, you know, I talked to somebody this morning they own a funeral home and graveyard. Multiples in that space are 12 to 15 times EBITDA. That same person's brother owns a glazing company, which is a construction business. And that guy cannot put 12 to 15 times on his construction company because his business is worth 3 to 5 times EBITDA, right? And so there's this huge discrepancy in the marketplace. Getting all that straight in the owner's head is a big deal. And basically what we're trying to do is justify their exit goals, ground them in reality before we move forward, because this process will cost a year of their life. It'll cost a lot of mental gymnastics. It'll cost real money, and so we don't even want to get started until we're kind of grounded in reality and we know that we're headed down a path where we have really high odds of success as our opportunity. So, and that brings us to checking the exit goals, right? So a lot of business owners have kind of similar exit goals along 5 different lines, and they'll reorder those 5 things based on their priorities. But every now and then, you know, we sold a business a couple of years ago where the son of the founder was a vice president, and he wasn't going to sell to anybody who didn't allow his son to be on the growth trajectory to be the president of that company, right? So there's very specific things that people may want in their transaction, and understanding that and reality checking those exit goals. If they're not based in reality, it's on us as their professional advisors to help them understand why and help them rearrange their thinking. And if they are, you know, we can validate that for them. So that's kind of where we're at there. This is from an actual transaction that we were involved in, and this is how we know that our third-party valuations do a good job, that they're accurate. If you can see the grouping in the middle there, most of the offers came in right in the middle of that valuation. Now, business is not worth a number. It's not worth $20 million. It might be worth $22 million to a certain strategic buyer, and it might be worth $17 million to another buyer who may not need the back office staff, or they don't complement each other that well. They're in a different geography or whatever. So the value of a business to the marketplace, to the buying community, is a range, right? And so if in our $20 million example, we would probably, in our valuation, come up with a number like $17,400,000 to $23,200,000 is the value range of this business. And so then we get into nuances, which I won't go into today, but how do we trade at the high end of the value range rather than the low end of the value range? What can we do to make that happen? You know, what kind of tax planning is involved? Do we need to do anything with inventory levels or personnel agreements or anything like that to move the value up higher in the value range? But this grouping of offers, we always have a low ball. We always have somebody who's so high it's unrealistic. Usually that's a public company on the high end. They want to throw a number out there, and then they work their way back towards the median during due diligence. We call that retrading. That happens quite a bit. So, but we got a good number of offers for this company, and you can see that they were grouped kind of in the middle of that value range, which means we know we're on the right track. And there's a good buyer in there that we can close with. And so when you're evaluating valuation companies and valuation partners, you just want to make sure that they have a means and a method to kind of proving that their information is accurate in the marketplace.
What were the EBITDA multiples of that business?
The question is, what were the EBITDA multiples of this business? And I don't remember exactly, but around 3 million in EBITDA was where this particular one was. And this was a pre-COVID transaction. I've been using this slide a couple of years. So, but it was a real transaction. That is where they fell. And that's pretty typical of what we see in our practice. We've had transactions where we get one offer, and we've had transactions where we get dozens of offers, but this is pretty typical. In this particular one, the industry was a landman business. They had about 75 professional landmen working for oil companies. On the exit goals, you know, these are the typical things that a business owner is going to want to see. They want their name and their legacy honored. There's a group of employees that have become family to them, and they really want those people taken care of. Everybody wants the highest price and the best deal terms, but what we found in the last 4 or 5 years is valuations are up, transactions are trading at historical high levels, and so once you kind of cross an economic threshold with a buyer, certain things will become more important than the highest price. And I would say at least half of the transactions we've been involved in the last 4 or 5 years, the highest price offer was not the eventual winner of the purchase. It was somebody who had a great career ladder for employees, or it was somebody who had some other fit, or maybe they did something special with the real estate, or some other factor came up and trumped highest price when the owner was really trying to determine, you know, who the best fit and what buyer do they want to close with. And so if you go back to these buyers, you know, there's 4, 5, 6 buyers in the middle here that make the short list, who are different deal terms, different types of buyers, different personalities, different company cultures, all that kind of stuff. And we sit with our business owners and we rank them. Which one is most appealing and why? Which one is least appealing and why? And then we go work on the transaction from that standpoint. Again, we're working for that owner to achieve their goals. So that's kind of how we do it. And these 5, you know, deals just kind of move around the ranking depending on who the owner is and what we're talking to. A lot of times the owner is a shareholder group, maybe 3 or 4 people, you know, and they can't agree. And so, you know, it's a tricky deal. And so then everybody hears me talk about a sale of a business, but there's really 3 things that go on in this marketplace. One is a merger. You all guys, you know, everybody knows what a merger is. They're just mushing 2 companies together and trying to figure out, you know, some people in this group are leaders and people in this group are leaders, and it's pretty equal. An outright sale is a 100% sale where shortly after transition, the selling shareholders, owners, founders, those people are going to go away, they're going to retire. But what happens, I'm going to say 70+% of the time in today's market in the last 4 or 5 years is a recapitalization, and most people don't even know what that word means. And basically a recapitalization, in terms of how we're going to talk about it today, is a buyer of your company is going to buy the majority of the equity, but not all of it, right? So I'm working on a deal right now for a business down the street here, and their buyer wants to buy 80% of the equity, and the seller is going to contribute their 20% back in, and they're going to be a minority shareholder with the buyer. And that is the most common way of exiting, selling, getting out of a business nowadays, is a recapitalization. It happens most of the time with a financial buyer, like a private equity firm or somebody who's doing a financial play. but it's easily 70+% of what we've worked on in the last 4 or 5 years. And that's really interesting, because then, you know, it's a scary thing to employees and vendors and customers to talk about a company being sold. And everybody's mind races to the worst place. But what you can do with recapitalization is you're not really selling, you're bringing on a partner to help you continue growing. And that's a much less scarier concept to employees and vendors and customers, when you can look them in the eye and say, hey, I'm still gonna be here, I'm still an equity shareholder, but I'm bringing in somebody, you know, who's gonna take this business to the next level as a partner. Right, so now you're talking about a partnership, and it's not so scary that the founder and the owners are exiting. So price and deal structure and terms are, you know, you can juggle those around, and if deal structure doesn't work, that $20 million that sounded great. In fact, I had a deal not long ago. It was $20 million, but there was only $4 million cash at closing. Well, that's $16 million at risk. So we advise our client, don't go there, right? Let's find something where you're getting the majority of your cash off the table now, that money's not at risk. And so deal structure is huge. And in that scenario, even though it sounds like $20 million, it's not guaranteed. So, and then the last thing we'll talk about, if we have time, is aligning with the transaction advisor. And that's what I am, that's what my firm is. So we'll tell you kind of how to do that best. I'm gonna watch the clock, make sure we don't go over. So, proven processes, we said that's where we're gonna start, right? Different processes produce dramatically different results, right? And so, first thing that a business owner should do is figure out kind of what their defendable valuation is, and then once they know that, they should think about, okay, what are my goals in this event that I'm trying to drive to? And once they get that lined up, then it ought to be, okay, there are 4 or 5 processes in the marketplace that can help me get there. Which one's best for my individual personal scenario? And then once you find a process that you like, there's probably a handful of companies in there that do that pretty well. Then you go start interviewing them for a good fit and, you know, and a good connection and something like that. And so just talking through that. But choosing the wrong process most of the time will end in no sale. Spend a year of your life, spend a whole bunch of money, waste a bunch of calories on chasing something that doesn't culminate. It's frustration. In certain cases, it can literally mean the death of a company. So picking the proven process that's right for you, your scenario, your exit goals, your culture, your shareholders is a big deal. And most people don't give that much thought to it. So what are the processes in this space of kind of 0 to 100 million in revenue businesses that I'm referring to? I don't know if you guys know Biz Buy Sell. That's a MLS website, kind of like if you were to list your house with a realtor, you could go online and look at all the houses. Biz Buy Sell is a place where you can do that for businesses. It's best at serving small Main Street car washes, nail salons, restaurants, those kind of things. If you've got a manufacturing business or a dealership or a larger business, it's not the greatest place to go, but it's a very efficient, fantastic marketplace for the really small businesses. Personalized matchmaking, that's all of your business owners, if they've been around very long, or right now they're getting phone calls and they're getting letters in the mail from somebody saying, we know you, you don't know us, we'd really like to talk to you about buying your company. Most of those letters are phishing, garbage, kind of unscrupulous players in the marketplace, but you would be surprised how many business owners, you know, think that that's something legit, and they start having meetings and sharing financials and giving away confidential information and stuff like that. So got to be really, really careful with personalized matchmaking. It makes a lot of sense in niche businesses where it's hard to attract a bunch of buyers. It makes a lot of sense if your business owner is ill and they can't stand the physical process of going through 9 or 12 months of selling the company, and we've got to get in there. So there are times where it does make sense, but it's a tricky part of the market. Invitation-only private sale is, in my opinion, most of the time the way to go. You align with somebody like me. Maybe your client is a plumbing contractor with 10 trucks and 40 employees. I could probably get 200 qualified buyers interested in that. Obviously not all in the same region, but people who are wanting to do regional roll-ups and conglomerates, somebody who's a mechanical contractor that wants to add plumbing. You know, it's a little bit out of reach of somebody who's trying to buy a job. It's definitely not an SBA size deal, so you know, there's a marketplace for businesses like that, and you've really got to understand how to run that process to do the invitation-only private sale, and you use the same tactics as the fourth one up here, which is an M&A auction. And auction is a deceiving word in this circumstance, but it is what we call it. And an M&A auction is we're gonna blast this out to the buying community. We're gonna get as much interest as we can. We're gonna play buyers against each other just like an auction would, bidders against each other, and we're just trying to drive the number up as high as we can in an exit process. And so some of these you can mix and match and combine them when you're representing your client, but as the accounting professional, somebody that they have a long relationship with, if they call us in, we haven't known them that long, and they're gonna build trust with us really quickly, and we have to be intimate with them, but they're always going to turn to you and go, hey, this is what we're doing. Does it sound right? Hey, this is what we're doing. Do you think this is the, you know, or can you run the math on this and tell me if, you know, those guys know what they're talking about? So, and then choosing the right model, I've said this a couple of times, that's what drives success, right? You run the wrong model, like if you have a business that's a great fit for an M&A auction, you're probably not going to sell it on the MLS websites. And you're going to drive yourself crazy with all the phone calls of people who aren't qualified to buy it, coming and wanting to kick the tires. So it's a big deal. Moving on to selecting an M&A advisor, right? So now you've kind of clarified what the defendable market value is of the business. You've clarified what the objectives are of the selling shareholders. You've clarified the math, the accounting, how much we're going to sell it for, how's that going to be carved up, where does it go? You're helping them understand their tax bill, what deal terms are, things like that. Once you get to that spot, you can start meeting with people like us, and we have a whole practice that starts way back at the front end and helps you get to this point too, so you could call us earlier. But most of my peers, this is where you would interview brokers and transaction advisors and intermediaries and investment bankers, right? And it's a mistake to meet with them and begin interviewing them until you can defend your value and clearly articulate your exit goals, right? Because they're going to ask you a bunch of questions that you don't have a good straight answer for. When you meet with them, you want to be able to communicate the terms of the deal that you're looking for and the desired outcome. Right, $20 million, but I'm not taking less than 12 at closing. Okay, that's a different deal than $20 million with 4 at closing. That's a different deal than $20 million all cash, right? And so understanding where those things are, most of these business owners are going to turn to their accounting partners for validation of what they're trying to accomplish, and you guys will be in on that conversation. Then you're going to, we just talked about this, you're going to look at the different representation models, and you're going to talk to the advisor that you're talking about. Which model do you do? Show me some transactions that you've done in this space that were successful doing that. You know, how can we know that you can run this model effectively? Do you have a junior team, or are we going to get you? Most of the time, the person that they're signing up with isn't the person who's going to be working on it. There's a team of interns and junior people, and you don't want that. You don't want to be an experiment for somebody. It's a one-shot deal for this client. And so once you kind of get through that part of the interview process with them, you really want to understand, how are you going to, this is our goal, this is where we're at, how are you going to drive me all the way to success? And does that smell like it makes sense? And have you done that before? And can you prove it? Do you have, you know, the references? And don't just check business references. Check attorneys and check other CPA firms and check people who are professional side of the transaction. I often will give references from the people that were on the other side of the table from us and say, hey, talk to the buyer's representatives and ask them if we conducted ourselves professionally and would they like to do another transaction with us, because that's the real telling part. So interviewing, all these things that I'm talking to you about today, I think business owners are commonly making mistakes with, and they're commonly getting poor advice from their professional advisors about, and so that's kind of why I'm just hammering the same points over and over. You know, once you kind of narrow down your advisors, maybe you've got 2 or 3 that kind of feel good and there's a fit and you don't know which one to pick. You know, ask yourself this question right here is huge. Most of my peers, including people I've interviewed to work for us, will kind of predetermine your business owner's fate in their mind, and they'll try to steer the ship to where they want it to go. And that's just not how this should work, right? We exist to listen to the business owner's objectives, help them put together a plan that makes sense, that's achievable, and then run that plan for their goals, not for my goals, right? And I will tell you, as the owner of a firm or co-owner, my partner Brett and I have had to sit many times and look at each other and go, hey, this is best for our firm, but this is what the client wants, so we're going to do this even though it's not best for our firm. And you need somebody who's going to make that decision every time, because the advisor will be faced with it at some point in every transaction. Oftentimes, we'll get a lower commission selling to one party than we would to another party. We're very conscious. We don't push the party that gives us the highest commission. We push the party that is the best fit to accomplish the owner's objective. I can't say that's true for all of my peers, and you can look at court cases and read the newspaper and figure some of that out, but it's important. Advisors are human, and they have a business model, and you need to make sure that what you and your client are getting into align with that. Representation terms are huge. We could talk about that all day, but you know, representation agreements have exclusivity, they have a tail, they have financial terms, there's confidentiality, there's non-disclosure, there's non-circumvent, there's all these different legal things that mean something. And so a lot of well-known advisors with huge marketing budgets and a whole legal staff are set up with terms that are just not right for most business owners who are looking to sell. And so be very careful if your client is coming to you saying, hey, what do you think about these terms? Because terms vary as much as the different advisors do out there. We've talked about which M&A model, but you know, if they're pushing one, it's probably because that's what they're geared to do the most. It's not necessarily what's best for the client. So how do you figure that out? And then vet the track record, right? A lot of advisors, you could Google their name and the word lawsuits, and it's very telling. We've never been sued, never even close. And so I don't know how that works, but I have a feeling, and looking at things in the marketplace, that the advisors' goals and objectives and the business sellers' goals and objectives aren't in alignment. Or the advisor's not doing what they promised they would do. So you want to vet those things. The advisors team, this is huge. Most advisors to business owners in this space are kind of a 1 or 2 person show. Maybe 1 or 2 people and a couple of helpers. Anything else they do, they're going to be hiring consultants, hiring, you know, if we need quality of earnings, you know, they're going to go to you guys or some division of one of your businesses maybe to have quality of earnings done, those kind of things. When the transaction components, the key components of the transaction gets out of the advisor's control, a lot of problems arise. So finding an advisor who is really strong in accounting is a huge deal. We have an accounting department. My CFO at Gilbert Pardue has had years and years of transaction experience. He is a CPA and he keeps his license active. That's a big deal, so he can run that department. Storytelling and forecasting are huge, and data metrics and things like that. And the buyers are going to hone in on that, and their due diligence will be brutal following those things. So doing that well is a big deal. How do they market? How do they advertise? Does it honor confidentiality? How do they screen their buyers? Is there a net worth or a pre-qualification letter requirement before they get confidential information? How do they research and do the data analytics? In our firm, we will do most of the buyer's work for them, so all they have to do is double check our work and confirm things. Makes for a very smooth process. But that's because we have all that horsepower in-house and we can offer that, and then we can stand behind it and defend it. Most of our peers don't. They will rely on the business owner to get with you. That's probably not your forte, so now you're doing something you really don't want to do, and it gets messy. Tax strategies, I don't have to talk to you guys about that, and then legal specialists. The wrong attorney can kill the best deal. Attorneys should be involved to manage liability, not to deal with accounting or business terms. Right? You guys are the accounting experts, we're the business term experts, they're the legal experts. Everybody stay in their lane, we'll have a good transaction. Attorneys oftentimes want to change the deal terms, want to change the finances, those kind of things. They get starry-eyed, they want to get a little combative, and they run our buyers off or irritate things. So you got to be really, really cognizant of that. And then the terms with an advisor. I mentioned this before, but exclusivity is a big deal. Most people think that selling a business isn't as expensive of a process as it really is. On that $20 million sale that we've been talking about this whole time, for your client to get the absolute best representation with the best opportunity for a great outcome, I would advise them to budget 10% for all the professional fees. So that's $2 million to go through this process. That is not a small amount of money. Now, most of that money, probably 80% of it, only comes if we close a transaction. But there may be $100,000 out of pocket during the process. Again, 6 figures is a lot of money. And so getting people, they don't want to chase the cheapest option. They don't want to go with the cheapest transaction advisor because you kind of get what you pay for. You want to find, this whole presentation has been about finding the best value, not the cheapest price. And the best value will end up being the most economical in the long run, but it doesn't look like that until the last day when the wire comes. And so understanding that, on most transactions, you're looking at 10, they're smaller than that, maybe even 15% of the enterprise value being what you should budget to go through the process and do it well and do it correctly. That's a surprise to most business owners. It's one they got to sleep on and mull over and argue with you and really figure out. But if they do a good job at vetting advisor, talking to you, asking the right questions, going through the pre-diligence process, then they'll come to understand that the value is there. And when you budget $2 million, you're going to get 20 as your outcome. If you budget $500,000, which again is still a lot of money, that $20 million sale may be a $14 million sale. So it's very short-sighted to whack $6 million off because you don't want to pay the right advisors. Really good advisors will have a breakup fee, right? So in our firm, if you want a $20 million exit structured like this with all these different proclivities, and we bring that to you, and then you say, you know what, I'm feeling healthy and I want to operate this business 4 more years, I'm going to decline that offer. Well, we did our job. We brought you the person who was going to buy it for those amounts and all those things. There's ways of doing that. Both parties have to sign it. But if they did and the seller decides to back out of the deal, well, we should still be compensated for doing our job. So most good advisors will have a breakup fee. If you have an advisor without a breakup fee, there's probably a lot of other things that they're naive about in this business, and you should just be wary of that. So that's kind of it. M&A is prevalent. Baby boomers are moving left and right. Lots of transactions happening. We're in Texas, one of the busiest states for other companies to be moving to, and a lot of our businesses are private equity, are gobbling things up. So if you guys have any questions, I'd be more than happy to field them for the next few minutes. If you want to call me or reach out to me at some point, the next slide, I think, yeah, the next slide has my information on it. You can get that out of the deck or take a picture of it or whatever. But any questions or?
What's the breakup fee percentage-wise?
So it's kind of all over the board, but if we go back to our $20 million example, you know, in our firm, we would probably earn 100,000 of that along the way and be expecting 7 figures at closing. Somewhere between, depending on the complexity of all the work that we did, you know, when I get to closing, I'm at a loss financially, and I'm looking to be made whole and then make a profit, right? So somewhere between 70% and 100% of what we were expecting at closing is typical of the breakup fee. That's pretty negotiable. We'll always say 100%, and we'll negotiate back if it makes sense. But if I've got $400,000 in this deal, by the time we get to closing, and I've only been paid 100, and I'm 300 in the hole, you know, we need to. It just needs to be fair to both parties.
Have you guys seen a slowdown in M&A as a result of the rising interest rates and cost of capital rather than buying?
So the question is, have we seen a slowdown in M&A because of rising interest rates and the cost of capitals for buyers? We have seen a lot of the weak buyers and the weak lenders fall to the wayside, and the strong buyers and the strong lenders are standing there still ready to transact and do deals. So what's happened to the clarity in the market, I like to say, has made it more efficient for us to get to the buyer that has the ability and the desire to close, and they have a lender or capital provider that has the ability and desire to support them. So yeah, it's changed the marketplace dramatically. It's caused a lot of people who don't understand it to kind of sit on their hands, and they're looking at interest rates going, I don't know if I want to do this now, and then next year they're looking at the election, and that's going to scare buyers and lenders a little bit with all the bickering that's going to go on TV. But the truth is, it has made the marketplace a little bit more efficient for us to go find that great buyer, they have a great lender or capital provider, and we get a deal done. Yeah, so appreciate your time, guys. We're done.